Today we're doing something a little different. Instead of looking at a live arbitrage opportunity, we are looking back at one of the most famous risk arbitrageurs of all time, Ivan Boesky. Ivan Frederick Boesky was born on the 6th of March 1937 in Detroit, Michigan. His father, William Boesky, was a restaurateur, best known for owning a chain of delicatessens and cocktail lounges in Detroit, which provided the family with financial stability, if not the riches Boesky desired. Ivan's mother, Naomi, had Russian roots, having immigrated to the United States as a child. Growing up, Boesky showed early signs of ambition and intelligence. He attended public schools in Detroit, but never showed a particular passion for academics. Instead, his interests seemed to lie in business and how to make money. His upbringing during the post-World War II economic boom gave him an acute awareness of the opportunities available and what a young man with hustle could achieve. Boesky's path through higher education was anything but conventional. After high school, he attended several colleges without completing a degree. His collegiate journey began at Wayne State University in Detroit, and he later enrolled at the University of Michigan. However, he left the University of Michigan before completing his degree. Boesky's academic career was marked by multiple transfers and a certain restlessness, as he sought to find his niche in the world. Despite his lack of a formal undergraduate degree, Boesky later attended the Detroit College of Law, where he earned his Juris Doctorate in 1965. His legal education would prove to be a valuable asset throughout his career, providing him with a foundational understanding of the law, which he would exploit in his later years of stock market arbitrage. By the mid-1960s, Boesky had met Seema Silberstein, the daughter of a wealthy New York real estate developer, who would later become his wife. Their marriage in 1962 connected him to the New York elite and the financial community, offering him a crucial entry into the world of high finance. Silberstein's family wealth also gave Boesky the financial support he needed to begin his investing career, and his association with her family opened doors to Wall Street firms. Boesky's foray into the world of finance began in the late 1960s. He initially worked as a stockbroker for a few years, gaining experience in the financial markets. However, Boesky's real interest lay in more sophisticated forms of market activity, particularly in the field of stock market arbitrage. Arbitrage, the practice of profiting from price discrepancies between two or more markets, requires a deep understanding of financial instruments and market mechanics. In Boesky's case, he focused on risk arbitrage, a strategy that involves buying shares of companies that are in the process of being taken over and taking a small but low-risk profit on the price discrepancy between the takeover price and the market price. Boesky's sharp instincts for identifying takeover candidates and predicting mergers allowed him to profit immensely from this strategy, often trading before any public takeover announcement had been made. In the early 1970s, Boesky began working on Wall Street, bouncing between several firms, including L.F. Rothschild and Edwards and Hanley, without leaving any significant impression, but learning the ropes and creating a network of future partners. By 1975, he had established his own arbitrage firm, Ivan F. Boesky and Company, with a $700,000 loan from his wife's family. This was the true beginning of Boesky's rapid ascent in the world of finance. Between 1975 and 1985, Boesky's firm enjoyed phenomenal success. His strategy of betting on mergers and acquisitions paid off handsomely. During this period, the U.S. economy was undergoing a major transformation, with deregulation, corporate raiders, and hostile takeovers becoming commonplace. Boesky thrived in this environment, quickly becoming one of the most powerful and influential figures in the world of finance. Boesky's success was built on his ability to identify which companies were likely to be targeted for acquisition. Using his network of contacts and his acute sense for market trends, Boesky became a master at predicting mergers before they were publicly announced. As a result, he was able to buy shares in target companies just before their stock prices surged, reaping millions in profits. During the decade between 1975 and 1985, Ivan Boesky emerged as one of the most formidable arbitrageurs on Wall Street, becoming a key player in the rapidly evolving world of mergers and acquisitions. His unique understanding of corporate takeovers, coupled with his legal training and a keen ability to navigate the complex financial mechanisms of arbitrage, allowed him to exploit market inefficiencies and reap enormous profits. This period of his career was marked by several notable investments, which significantly increased his influence in the financial world. Despite its modest beginnings with just $700,000 in capital, or $4.1 million in 2024 money, which was considered modest by Wall Street standards, Ivan F. Boesky and company quickly gained traction due to Boesky's reputation for accurately predicting which companies were likely to become the targets of mergers, hostile takeovers, and leveraged buyouts. His firm's primary focus was on risk arbitrage, a strategy where Boesky would purchase the stock of companies that were rumored or expected to be acquired, then sell the shares after the acquisition was announced and the stock price rose. At its core, risk arbitrage capitalizes on the spread between the pre-merger stock price and the price at which the acquiring company is expected to purchase the target. The profits can be significant if an investor accurately predicts the outcome of the merger. Boesky proved to be a master at identifying these opportunities. His deep network of contacts in the investment banking and corporate world gave him access to early information about mergers and acquisitions. By the early 1980s, Boesky and company had grown exponentially, with assets under management reaching close to $200 million, or $652 million in 2024 money. By the mid-1980s, his firm was managing over $3 billion in capital, equivalent to $8.8 billion in 2024, an astonishing growth rate that placed him among the most powerful investors in the world. Though much of Boesky's early activity was in relatively obscure or mid-sized companies, his ability to early identify likely takeover targets resulted in his participation in several high-profile deals, promoting him to the big league of finance and solidified his reputation as an investing icon. Some of his most notable deals included Stokely Van Camp's acquisition by Quaker Oats in 1983. Boesky made a sizable bet on Stokely Van Camp, the company best known for Gatorade, anticipating its acquisition by Quaker Oats. His firm had quietly accumulated shares of Stokely, betting that Gatorade's growing popularity would make the company an attractive takeover target. When Quaker Oats eventually purchased Stokely Van Camp in 1983 for $226 million, or $715 million in 2024 money, Boesky was able to cash in on the stock's price increase. General Foods acquisition by Philip Morris in 1985. Boesky was heavily involved in the General Foods Corporation deal when it was acquired by tobacco giant Philip Morris in 1985 for $5.6 billion, or $16 billion today. This deal marked the beginning of Philip Morris' diversification strategy, as it sought to expand beyond tobacco into the food and beverage industry. Boesky's foresight in accumulating shares of General Foods before the merger announcement once again yielded large profits for his firm. The Gulf Oil and Chevron merger in 1984. One of Boesky's most famous and profitable trades came during Chevron's acquisition of Gulf Oil in 1984. This merger was part of the wave of consolidations in the oil industry, spurred by falling oil prices and rising competition. Boesky correctly anticipated that Chevron would win a fierce bidding war for Gulf, and he bought a significant amount of Gulf oil stock ahead of the deal. When Chevron ultimately acquired Gulf for $13.2 billion, one of the largest mergers of the time, equivalent to $40 billion in 2024, Boesky made millions in profits from his strategic investments in Gulf stock. The Nabisco RGR buyout in 1989. Another major win for Boesky came from the buyout of RGR Nabisco, a tobacco and food conglomerate, which would later become notorious as the largest leveraged buyout in history. Boesky had invested heavily in Nabisco's stock, anticipating consolidation in the consumer goods industry. When the leveraged buyout was announced by Colbert Cravis Roberts and Company for $24.88 billion, or $63 billion in 2024, his shares skyrocketed, leading to substantial profits. Through these 4 large transactions and several smaller deals, Boesky's investment firm made millions of dollars. His risk arbitrage strategy was seen as cutting edge at the time. allowing him to stay ahead of the curve in a competitive market. By the early 1980s, Boesky was managing hundreds of millions of dollars and earning a reputation as one of the leading figures on Wall Street. He frequently appeared in financial publications and was known for his lavish lifestyle, which included a mansion in Westchester County, New York, and a vast art collection. In 1984, he published a book titled Merger Mania, which outlined his thoughts on the corporate merger wave and the strategies that had made him so successful. However, despite being the golden boy of the arbitrage world, not everything Boesky touched turned to gold. In 1984, Boesky made a high-profile attempt to take advantage of the consolidation in the steel industry by purchasing a significant stake in Armco Steel, a major U.S. steel manufacturer. At the time, the steel industry was under tremendous pressure due to rising competition from overseas producers and declining domestic demand. Boesky saw Armco as a prime candidate for a buyout or restructuring, which he hoped would lead to a substantial profit. However, the steel industry's troubles ran deeper than Boesky anticipated. Armco's stock did not perform as expected, and there were no interested buyers willing to engage in a takeover bid for the struggling company. Additionally, Armco's financial condition continued to worsen, and the stock price fell sharply. Boesky, having built up a significant position in the company, lost millions on the trade. The Armco debacle underscored one of the challenges of Boesky's arbitrage strategy. While it worked well in industries with high levels of merger activity, sectors like steel, which faced fundamental economic problems, were far riskier. Boesky's inclination to invest prior to the announcement of deals further compounded the risk profile and losses he faced. Boesky was also involved in one of the most dramatic corporate battles of the 1980s, the attempted hostile takeover of Union Oil Company of California. In 1985, T. Boone Pickens, a well-known corporate raider, launched a bid to acquire Union Oil as part of a wave of oil company takeovers during the period of low oil prices. Boesky, seeing an opportunity in the unfolding battle, began purchasing large amounts of Union Oil stock, betting that Pickens' bid would succeed and that Union Oil would be sold at a premium. However, Union Oil mounted an aggressive defense against the takeover, employing a legal tactic known as a Pac-Man defense, where the target company attempts to buy back its own stock at a high price to fend off the raider. Union Oil's defense proved highly effective, and the stock buyback plan diluted the value of Boesky's shares, leading to substantial losses. The Union Oil case also highlighted the unpredictability of the risk arbitrage business, particularly when hostile takeovers are involved. Boesky had believed that Pickens' aggressive tactics would force Union Oil into a sale, but the legal and financial maneuvering by Union Oil's management caught many investors, including Boesky, off guard. One of the most significant setbacks for Ivan Boesky came during the attempted takeover of Turner Broadcasting System in 1985. TBS, owned by media mogul Ted Turner, was a highly visible company known for its ownership of CNN and other media properties. In the mid-1980s, Boesky believed that TBS was an attractive takeover target, as Turner was looking to expand the company's reach in the cable television industry. Boesky, seeing an opportunity to profit from an expected corporate takeover, accumulated a large position in TBS shares, anticipating a buyout that would push the stock price higher. However, the deal did not play out as he had hoped. TBS's financial situation was far more precarious than Boesky had anticipated, and potential buyers hesitated due to concerns over the company's large debt burden. To make matters worse, TBS's stock price dropped significantly after Boesky had taken a large position, resulting in heavy losses. The situation was exacerbated by Ted Turner's own financial difficulties at the time, which made it unlikely that any major buyer would emerge to acquire TBS at a premium. Boesky was forced to exit the position at a loss, marking one of the more publicized failures in his career. The TBS debacle demonstrated the volatility and risk inherent in his investment strategy, particularly when the anticipated takeover target was not as appealing as initially believed. Boesky continued unperturbed, his profits from the good deals far exceeding the losses on the bad. Boesky's reputation as a financial genius was cemented in 1985 when he made a famous speech at the University of California, Berkeley, in which he extolled the virtues of greed. He told the audience, "Greed is all right, by the way. I want you to know that. I think greed is healthy. You can be greedy and still feel good about yourself." This speech would later become infamous as a symbol of the excesses of Wall Street during the 1980s, and was widely quoted in the 1987 film Wall Street, where Michael Douglas' character, Gordon Gekko, famously declared, "Greed, for lack of a better word, is good." With his widening fame, Boesky's network of contacts continued to grow in size and stature. One new contact added in the 1890s was Michael Milken. A crucial component of Boesky's success was his relationship with Michael Milken, the famed junk bond king and head of Drexel Burnham Lambert's high-yield bond department. Milken and Boesky became closely associated during the 1980s, as both were key players in the corporate takeover boom. Milken, through his innovations in junk bonds or high-risk, high-yield bonds used to finance leveraged buyouts, helped provide the capital for many of the mergers and acquisitions that Boesky profited from. Milken's junk bond financing became the backbone of the 1980s corporate raider movement, enabling hostile takeovers and buyouts of companies that were previously too large to target. Boesky and Milken's relationship was symbiotic. Boesky, as an arbitrageur, would profit from the takeover rumors, while Milken would structure the financing for the deals. They were both part of a network of financiers who pushed the boundaries of traditional corporate finance. But their collaboration would also lead to their eventual downfalls. Milken's role at Drexel Burnham Lambert helped make the firm a powerhouse in the world of mergers and acquisitions, and Boesky's access to Milken's network of insiders gave him an edge in predicting which companies were next in line for takeover bids. However, it was also through this network that Boesky was able to obtain legal inside information, specifically through intermediaries like Dennis Levin, who was also connected to Drexel. It was around this time that Boesky's career reached its zenith. At the height of his success, Boesky's personal fortune was estimated at over $200 million, the equivalent to $500 million in 2024. His firm's massive capital under management, which exceeded $3 billion at its peak, was supported by his uncanny ability to leverage risk arbitrage with precision timing. Boesky was known for making aggressive bets on mergers, using both his firm's capital and borrowed funds. In some cases, he employed leverage of up to 10 times his capital, amplifying his gains dramatically when his predictions were correct. Equally as big as his financial bets was his lifestyle. Ivan Boesky was known for his lavish lifestyle, spending his wealth on a wide range of luxury items, properties, and philanthropic endeavors. His spending habits reflected the excess and opulence that defined Wall Street in the 1980s. Boesky owned a sprawling estate in Westchester County, New York, which was valued at around $20 million during the 1980s. This estate was considered one of the most expensive properties in the area, featuring expansive grounds, luxury amenities, and a mansion where Boesky hosted high society events. The estate symbolized his wealth and status, and its value placed him among the elite of New York's financial world. Boesky also owned a luxury apartment in Manhattan, where he spent much of his time when conducting business in the city. This property was lavishly decorated, featuring fine art, high-end furnishings, and state-of-the-art amenities. Real estate in Manhattan was extremely expensive even in the 1980s, and Boesky spared no expense in acquiring prime locations. Boesky's real estate portfolio extended beyond New York. He purchased a mansion in Beverly Hills, California, adding to his collection of high-end properties. This home was a reflection of his status on both coasts of the U.S., and it further solidified his reputation for living a life of luxury. He owned further properties in Florida and Europe. Ivan Boesky was also a passionate collector of fine art, spending millions to amass a notable art collection that included works by some of the world's most renowned artists. Boesky's collection included works by famous artists such as Claude Monet, Pablo Picasso, and Vincent van Gogh. These pieces were often bought at auction for millions of dollars and were displayed in his various homes, showcasing his refined tastes and deep pockets. In addition to traditional paintings, Boesky also collected sculptures and more contemporary works, reflecting his desire to be seen as a sophisticated and cultured figure. The value of his art collection was estimated to be in the tens of millions. Many of these pieces were considered investment grade, appreciating in value over time. His art purchases were part of a larger trend among Wall Street elites in the 1980s, where owning masterpieces became a symbol of wealth and power. Boesky's collection put him in the same league as other wealthy art collectors, and it was a significant part of his overall financial portfolio. Like many Wall Street titans of his era, Boesky enjoyed the perks of private jets and luxury yachts. These allowed him to travel the world in style and comfort. Boesky owned a private jet, which he used for both business and personal travel. This not only saved him time, but also provided the convenience of traveling on his own schedule, a luxury reserved for the ultra-wealthy. He also spent heavily on luxury yachts, which were another status symbol among the financial elite. These vessels allowed him to entertain clients and friends in lavish surroundings, often in exotic locations. In addition to his opulent lifestyle, Boesky was also known for his philanthropic activities during the height of his career. He made substantial donations to educational institutions and charitable causes, which were partly aimed at enhancing his reputation as a civic-minded and generous figure. Boesky and his wife made significant donations to various universities, particularly in support of Jewish studies programs and other academic initiatives. Boesky's philanthropy in education was seen as an attempt to bolster his image as a thoughtful and intellectual businessman, rather than just a financial wheeler-dealer. One of the most notable donations was made to the University of Michigan, his alma mater, where he funded scholarships and programs. However, as is usually the case, when people fly too close to the sun, they tend to get burnt. And so it was with Boesky. The investigation that eventually led to the downfall of Ivan Boesky was part of a broader crackdown on insider trading and illegal financial activities on Wall Street during the mid-1980s. This period was marked by aggressive mergers and acquisitions, with corporate raiders and arbitrageurs like Boesky capitalizing on the volatility of takeover rumors. However, with so much money at stake, the temptation for insider trading was high, and Boesky ultimately became one of the most infamous figures caught in the web of illegal market manipulation. The investigation that ensnared Boesky began with Dennis Levin, an investment banker at Drexel Burnham Lambert. Levin had been engaged in illegal insider trading, using non-public information about upcoming mergers and acquisitions to make profitable trades. He was part of a broader network of insiders who shared confidential information in exchange for kickbacks or reciprocal trading tips. In May 1986, the U.S. Securities and Exchange Commission launched an investigation into Levin after suspicious trading activity was noticed. Levin had been using offshore bank accounts in the Bahamas to funnel illicit profits from his insider trading. After being confronted with evidence of his illegal trades, Levin agreed to cooperate with the SEC and the U.S. Attorney's Office in exchange for a reduced sentence. His cooperation would ultimately unravel one of the largest insider trading scandals in U.S. history. Levin's testimony implicated several individuals, but the most prominent figure in his network was Ivan Boesky. Boesky had paid Levin substantial sums of money in exchange for inside information about pending corporate takeovers. This insider knowledge allowed Boesky to place massive bets on companies before their stock prices surged following the public announcement of mergers, netting him millions in illicit profits. His reliance on inside information eventually became his undoing. As his firm's assets ballooned and his deals became ever larger, he increasingly turned to illegal insider trading to maintain his edge in the highly competitive world of arbitrage. Boesky's primary source of insider information came from his association with Dennis Levin. Levin provided Boesky with confidential information about pending mergers and acquisitions, which Boesky used to place profitable trades ahead of the public announcement of these deals. This practice was illegal, as it violated the trust and fiduciary duties that corporate insiders and investment bankers had with their clients. In return for this information, Boesky paid Levin substantial sums of money, often using offshore accounts to hide the transactions. When Levin was arrested in May 1986, the dominoes began to fall. Levin agreed to cooperate with the authorities in exchange for leniency, and he implicated Boesky as one of his main clients. As investigators delved deeper into the case, they discovered the extent of Boesky's illegal trading activities. Boesky's insider trading extended beyond his dealings with Levin. He had cultivated a vast network of corporate insiders, lawyers, investment bankers, and other market participants who provided him with confidential information in exchange for financial rewards. This network allowed Boesky to stay ahead of the market and consistently profit from and activity. Boesky's illegal trades involved several high-profile mergers, including those between Gulf Oil and Chevron, General Foods and Philip Morris and Nabisco. In each case, Boesky used insider information to buy shares of target companies before the deals were publicly announced, selling them once the stock prices rose. The scale of his illicit trading was massive, and the profits he generated were substantial. It is estimated that Boesky's illegal insider trading netted him close to $50 million in profits, the equivalent of $130 million in 2024. By 1986, Boesky's firm, Ivan F. Boesky and Company, had grown to manage over $3 billion in assets, a significant portion of which was built on the back of illegal trading activity. Facing overwhelming evidence of his illegal activities, Ivan Boesky chose to cooperate with the SEC and the U.S. Attorney's Office, much like Dennis Levin had done before him. In November 1986, Boesky agreed to a plea bargain with federal prosecutors. As part of the agreement, he would pay a record $100 million in fines and settlements, and he would serve a reduced prison sentence in exchange for his cooperation with the ongoing investigation into insider trading on Wall Street. Boesky's cooperation was crucial in bringing down other prominent figures involved in the scandal, most notably Michael Milken, the junk bond king of Drexel, Burnham Lambert. Boesky provided authorities with evidence of Milken's involvement in insider trading and other illegal activities, which would later result in Milken's own conviction and imprisonment. Boesky's testimony helped prosecutors build their case against Milken, making Boesky a key figure in the broader crackdown on financial misconduct during the 1980s. In December 1986, Ivan Boesky formally pled guilty to one count of conspiracy to commit insider trading. The charge carried a maximum sentence of 5 years in prison. However, due to his cooperation with the government, Boesky received a more lenient sentence. In December 1987, he was sentenced to 3 years in federal prison, far less than the maximum penalty he could have faced. In addition to his prison sentence, Boesky was permanently barred from working in the securities industry, effectively ending his career as a Wall Street arbitrager. The $100 million fine he paid to settle civil and criminal charges was one of the largest penalties ever imposed on an individual at the time. Boesky's downfall sent shockwaves through Wall Street. Once hailed as a brilliant financial mind, he was now seen as the embodiment of the greed and excess that had come to define the 1980s financial boom. His case became a symbol of the dangers of unregulated markets and the ethical lapses that had become rampant in the world of high finance. Boesky began serving his sentence in 1987 at Lompoc Federal Prison Camp, a low-security facility in California. Though his sentence was for 3 years, Boesky served only 22 months before being released on parole for good behavior. His time in prison, though brief, marked a dramatic fall from grace for a man who had once been at the pinnacle of the financial world. While in prison, Boesky reportedly spent much of his time reading and reflecting on his actions. It was a period of significant personal introspection, though little was shared publicly about his prison experience. Upon his release, Boesky largely retreated from public life. Though Boesky paid a substantial fine and had a portion of his assets seized, he still retained a significant amount of wealth after his release. It is estimated that even after his legal troubles, Boesky's personal fortune was still in the range of tens of millions of dollars. His Westchester County estate, which was valued at around $20 million, was eventually sold, and he downsized his living arrangements. Boesky's marriage to Seema Silberstein ended in divorce shortly after his release from prison. Their marriage had long been strained by his legal troubles and public humiliation. The divorce further isolated Boesky from the circles of wealth and influence he had once moved in, and he became something of a social pariah in elite financial and social circles. In the years following his conviction, Boesky's name became synonymous with the excesses and ethical lapses of Wall Street in the 1980s. His infamous 1985 speech at the University of California, Berkeley, where he stated that greed is all right and you can be greedy and still feel good about yourself, became a defining moment in the public's perception of Wall Street. That quote was immortalized in the 1987 film Wall Street, in which the fictional character Gordon Gekko, played by Michael Douglas, delivers the now famous line, "Greed, for lack of a better word, is good." Boesky's role in the insider trading scandal also had a lasting impact on financial regulation and the enforcement of securities laws. His conviction, along with those of Michael Milken and others, led to significant reforms in how insider trading was monitored and prosecuted. The Securities and Exchange Commission and other regulatory bodies began to take a more proactive approach investigating financial misconduct, and new laws were introduced to strengthen the penalties for illegal trading. Though Boesky's public life effectively ended after his release from prison, his story remains a cautionary tale about the dangers of unbridled greed and the consequences of crossing ethical boundaries in the pursuit of financial success. Thank you for watching.